Imagine this. You spend 10 years of your life building an empire. Late nights, stress, discipline, sacrifice. Today, you're finally stable, profitable, in control. Then one day you decide to bring a new partner into your company. You give them 50% ownership, no audit, full access to the bank account, half of all future profits. And if they ever want to leave, they can walk away with half the cash, half the IP, and maybe even future payouts. You didn't run a background check, didn't check their credit history, didn't understand their financial habits. You just signed based on a gut feeling. In the business world, if you did this, people would call you irresponsible, reckless, career-ending stupid. But here's the strange part. Every year, millions of people sign this exact deal. We don't call it a merger, we call it marriage. Marriage feels romantic, but in the eyes of the law, it's a financial partnership. Two people don't just merge emotionally, they merge economically. The moment you say, "I do," you activate tax rules, debt liability, property rights, everything. Most people read iPhone update terms and conditions more carefully than the legal consequences of marriage, and that's the biggest blind spot. Financial incompatibility is slow poison. Opposites in hobbies look cute. Opposites with money, they're destructive. If one partner is a saver and the other is a spender, the relationship doesn't stay romantic, it becomes a cash flow battlefield. Let's look at simple math. A disciplined person saves $20,000 a year. Over 30 years at 8% growth, that's roughly $2 million. Financial freedom. Now imagine the partner spends heavily. Luxury car leases, impulse shopping, frequent upgrades, enjoy life purchases. An extra $15,000 drain every year. Savings drop to $5,000 a year. After 30 years, about $500,000. The difference? An invisible $1.5 million leak. No stock crash, no scam, just lifestyle friction eating the future alive. And the emotional damage? The saver becomes the villain. The spender becomes the victim. Every bill becomes an argument. Every purchase becomes a debate. Eventually, the saver gets tired. Standards drop. Dreams quietly expire. Then comes the sudden death scenario. Divorce. Statistically, 40 to 50% of first marriages fail. A coin flip. Divorce isn't just an emotional break, it's an economic earthquake. One house becomes two. One expense system becomes duplicate expenses. Economies of scale collapse. Lawyer fees, asset liquidation, taxes, selling costs. A couple with $500,000 net worth can easily lose 60 to 70% of their purchasing power. And if alimony is involved, your ex becomes a recurring liability. You're generating income, but you can't retain it. Wealth is being created, but it doesn't stay with you. This isn't cynicism, this is protective realism. Money fights attack love directly. A strong marriage isn't built on romance, it's built on alignment. Financial transparency is the backbone of trust. Financial infidelity is real. Hidden debt, secret credit cards, undisclosed loans. You are legally linked to your partner's money behavior. If they sink, you sink with them. So what's the solution? Not canceling romance, managing risk. Step 1. Have money conversations before commitment. Open books, credit, debt, habits, values. Ask, what does money mean to you? Security? Freedom? Status? That answer predicts the future. Step 2. Don't see a prenup as an insult. See it as insurance. Insurance isn't a crash plan, it's a safety net. Clear rules protect love. Ambiguity creates conflict. Now hear the flip side. An aligned marriage is a wealth accelerator. Two disciplined earners, one lifestyle, shared goals, explosive compounding. Marriage with the wrong partner is a trap. With the right partner, it's a superpower. A stay-at-home spouse also plays an economic role. Career sacrifice equals hidden investment. There must be protection structures. A household is a business. Both partners contribute. Salaries may differ, value does not. Ultimately, choosing a partner feels like an emotional decision. In reality, it's a lifetime asset allocation. Time, energy, income, future. You're investing everything into one stock. Choose a blue chip, not a volatile meme stock. Choose someone who compounds you, not discounts you. If you're single, financial literacy is as attractive as personality. If you're dating, don't avoid money conversations. If you're married and there's imbalance, build systems, automation, guardrails, separate lanes. Hope is not a strategy. Structure is. Marriage is a high-risk, high-reward deal. Upside, infinite. Downside, brutal. Do your due diligence. Use emotion and logic. A broken heart can recover. A broken retirement account often cannot. If this made you uncomfortable, that's probably why this conversation is necessary. Share it, not to start a fight, but to protect the future.